Hi folks, time to take a look at chapter 8. So, as you can see, highlighter, chapter 8, it's about receivables, okay, count receivables, by the way, asset on the balance sheet, bad debt expense, obviously an expense on the income statement, people don't pay, right, they don't pay their bills, and then interest revenue. This has to do with when we loan somebody money and we're getting interest, okay? So let's take a look. All right, so the first thing we want to talk about, there's some trade-offs to extending credit. So when a company decides to give you credit, matter of fact, department stores used to do it all the time. I mean, I don't know, I'm sure probably some of you have a Target credit card or whatever. I mean, they did it for a number of reasons, but we want to take a look at the good, what's the good, and what's the not so good, okay? So the big advantage. So why do people want to extend credit? What's the purpose? If you're in bid, by the way, you guys, even if you're not an accounting major, right? So you're not an accounting major, but you're in business, right? So you're like, why in the world would you give anybody credit? Why don't you just tell them, hey, pay cash or you don't get it? Real simple. It increases revenues. That's it. Simple reason is that. If it didn't do that, nobody would do it. By extending you credit, instead of making you pay for it right then, they know they're going to sell more. By the way, just like cars. Imagine if you went to the car dealership and you couldn't get a loan for a car. The only way to buy a car would be to walk in there with cash to buy a car. How many cars do you think they would sell? Not a whole lot, especially for a lot of people, probably me too. How about for a house, right? So credit, it's a big thing. So what are the disadvantages? And there are several, right, that you have to take into account. But truthfully, the advantage of selling more outweighs the disadvantage. Number one, you have additional wages because you need a credit department. So somebody has to decide who gets credit and how much, right? Obviously costs money, right? Next one, bad debt cost. Okay, some people don't pay. Some folks don't pay. It doesn't mean that necessarily they're bad. Maybe something happened. Maybe they got sick. They got fired from their job. I don't know. And then other people abuse it. But the reality is that bad debt, it's part of business, right? So you have to understand that. It's part of the risk you take. And then finally, delays receipt of cash. So in other words, you don't get paid for a while. Now that could be a problem because you have to wait for your money. Everybody's got bills to pay, right? So how long can you wait for your money? And again, depending upon the circumstances, okay? All right, so here you go, main question. Again, these are kind of common sense things you need to know. What is the main advantage for companies to extend credit? Why do they do it? Why do they do it? Okay? Chapter 8, question 1, don't forget, it's for that quiz that you're going to have on Canvas, right? Yeah, on Canvas, okay? All right, now, how do we estimate? Well, my little thing went, there you go, now it's doing it. How do you estimate and then report these uncollectible accounts? Uncollectible account. How do you do that? Okay, so there's there's ways that we do it, and we have to go through that process, okay? So the first thing that happens, notice here, like on January 1st, right? So we make a sale. We make a sale on account. So what that means is we have an account receivable. We debit account receivable, that's an asset, and we credit sales revenue, right? So on our balance sheet, we don't have the cash yet, but we have that account receivable, right? So we know we have that account receivable. And on the income statement, we show the revenue, right? Now, the problem is we don't know if people are not going to pay us. We don't know about bad debt until after the period. So, right, so what we have to do is somewhere in here, we have to estimate this. So we make all these sales on account. But remember, we're trying to match revenues and expenses. So the expense of the bad debt for those sales needs to be in the same period. But we won't know it actually. We have to estimate it, okay? We have to estimate it, all right? So what we do, take a look. So we got January 1st, we record that debit to our asset, credit to sales revenue. And then what we do is we record an estimate of the bad debts. We don't know for sure, but we approximate it. And what we do, we debit something called bad debt expense. And by the way, bad debt expense, it's an expense and it lowers stockholders' equity through retained earnings. And then we have allowance for doubtful accounts. Notice, this is a contra asset, so it lowers an asset. And the asset that it lowers is the accounts receivable. So what we do essentially is we estimate that bad debt and we put it in this allowance for doubtful accounts, which acts like a cookie jar, okay? So we have this allowance. So notice here, let's say we had $10,000 in sales, credit sales. We estimated 2%, so that'd be $200. So the amount we expect accounts receivable net will be $9,800. That's what we would expect to collect out of the $10,000. Expect. We don't know for sure yet. And by the way, over here we'd have bad debt expense. Notice here, after gross profit, this is another expense, just like electricity, employees, $200, and this is the cost of credit. So there's always a cost associated. And now some companies are really good at giving out credit. They don't have a big problem with it. Other companies not so good. By the way, it's a big deal. But we don't know. When bad debt is known, it's actually known later. Then we make an adjustment. So what we do is we use the money in this cookie jar. You know that allowance? We use that money, okay? That cookie jar money. All right, according to Dr. Cohen, that wise man, which of the following accounts is like a cookie jar? Okay, which one of these is like a cookie jar? Don't forget to mark down your answer so you can put it in the quiz that's going to be on Canvas. Okay? All right, so here's what happens. Oops. So we went through this whole thing. So now we know, let me move this picture here. So now at this point, we know what the bad debt is, okay? So before we had bad debt expense and allowance for doubtful accounts. This is our estimate. This is our estimate right here. Now when we actually know something is bad, we know it's actually bad. We don't think it now, we know it. What we do is we use part of this allowance, so we debit that allowance. So basically we're using the cookies from the cookie jar, and then we credit accounts receivable. We lower the accounts receivable. So what we do is we take that estimate that we put aside in allowance, and now we're actually using the allowance. So when the bad debt actually happens, then we use that allowance. Before that, it's an estimate, okay? But by the way, that's how we have to do it because we're trying to match everything up. Otherwise, stop and think. If let's say you didn't do that. Let's say August 1st you sold $100,000 worth of stuff. And they're supposed to pay you in 30 days, right? So you make your sale and whatever, and you don't do any kind of allowance. And then 3 months later, you find out they're not going to pay you. Then you would be taking that expense against 3 months ago instead of today. So again, this is our best way to try to estimate to get everything together, to get all the expenses and the revenues together in the same time frame. Okay? So next question, question number 2. Here it is, folks. Is bad debt expense, look, is bad debt expense, is it an exact number or is it an estimate? Is it an exact number or is it an estimate? Okay? All right. Question number 3, make sure you write it down. This way you could do it, put it in your quiz. All right. Now this allowance method, there's a 2-step process. So the first process is the estimated bad debts. That's what we were talking about so far. And then the second part is the write-off of the specific customer when it is known to be uncollectible. So what they mean by this is that, okay, now we know We're going to use the money in the ADA cookie jar. So now we don't think it's going bad. We know it's going bad. Okay? All right, folks, that's part 1 from chapter 8. Back with part 2 in just a minute.